All right, all right. Good morning, good afternoon. Everyone still doing okay? All right, just give me confirmation you're able to hear me and you can see the document. Change the background. Yeah, I found Yosemite wallpaper appearing on my desktop. So the Microsoft Windows, it keep changing the desktop, the wallpaper on the desktop, and I really like the Yosemite one. So I thought, okay, I'll change it. I had moon. I think I have a few more. I love landscapes. So I found this Yosemite really good. Let's see how long it continues. You know, I won't hesitate to change it if I find something else more interesting. Kristen says, love the changes in wallpaper. Thank you. But I'm not sure how many of you love the changes that have happened in the market this week. Interesting market. Right? What else? Do we have anyone new? Oh, not yet. So today, oh,
I think
yeah.
with Intel, you said it was a winner or not a loser, but the press said that it was a loser for both those days.
So we will talk about Intel. So hold your questions on Intel. Uh, so you see the logos, and I think this is probably our first time in 4 years, ever since we've been doing these sessions, more than 4 years. I'm going to talk about so many of these companies. I don't recall any session where we discussed like 10, 15 companies. And of course, the reason is there've been earnings and also, I mean, this week was a heavy week on earnings. And also, I think as we started from last week, I'm gonna, give you guys an opportunity to say, hey, can you review these 5 companies? And so I'm gonna talk some of those that came from our last week's session. So we'll give you a quick overview of how those companies numbers looks like, just a financial numbers and various metrics. So huge puts on Intel at 20. I hope that someone bought the put maybe before Intel went down. It doesn't make sense if you buy it now. Those will be pretty expensive ones. Let me see. At what expiration? Is 16th August? 17,000. Yeah, 17,000 volume. But open interested only 616. So looks like many of those got closed. Yeah, Intel, not a great story. So we will talk about it. What else? I'm going to also dig a little deeper into the macro, because this was a week when we had Fed chair, Fed had its FOMC meeting. And that's the only time when I would want to discuss a little bit of a macro. And this week was like all about macro. Nothing else moved the markets as much as macro moved the market this week. So makes sense to spend some time on macro. Please review Cisco and Renesas Semiconductor if we get time. I don't think we'll have time for today. So as I said last week, I want to have a forcing function. If you want to give me a company that you want me to run through those criteria, you have to tell me 2 things. Name of the CEO of the company and what is the market cap of the company. Okay. So those 2 things I'll need. So Sam, go ahead and tell me, put in the chat the name of the CEO of Cisco and Renesas and what's their current market cap. Okay. I'll add into the list for tomorrow. So right, in first 15 minutes, we might take those stock requests. So Sam, you have to give me the CEO name and the market cap of Cisco and Renesas. Fred says, we've been having issues with i7 and i9 CPUs on desktop that we have been deploying. Oh, okay, that I think that's a comment related to Intel. Yeah, I mean, I don't have much because Intel is very small part of my position. Now it has become even smaller, right? So I don't have like my investing thesis like I have for other companies. I haven't dug really deeper into Intel. My only reason investing thesis on Intel was it is strategically important for US, right? That doesn't really mean that the business is great or the company is doing great, but that's the bet that I had taken. It's a very small position, right? So less than 1%, even less than, I guess, 0.5%. So it doesn't really matter much. Yeah, Suprabhat, Aditya. All right, all set. Cisco, Chuck Robbins, and the market cap is $188 billion. All right, this goes in the consideration list. So you get to pick, depending on how many requests we get, I will try to at least, make sure everyone gets a chance to review a company of what they want to. So if I don't have full 5 names, then I'll pick both Cisco and Renaissance from you, Sam. Otherwise, I'll pick one and we'll keep another one for next week. AMET, $150 billion, Gary Dickerson. Okay. All right. I've never heard of name because I don't own AMET, so I've never even maybe Gary is not that media what do you call friendly or not much in the news. Maybe the company. I mean, it provides tools for semiconductor because this I've not heard like Gary Dickens much. Chuck Robbins, yeah, he's been on financial media, and he talks a lot more than Gary. So it will be good to see AMAT. All right, guess time to get going. we got two main agenda today, macro review, and then almost 15 or 16 companies that we're gonna review today. Some I'm gonna run through those, some quality metrics. Some those have reported results this week. We're gonna run through the results. And it was a super busy week for me because a lot of companies reported results. I've been able to update my thesis document with some of them not. So depending on where the situation is, we'll review it accordingly. All right. So let's dive in, guys. Unless you have anything else. Sorry, I'll be sipping coffee. I didn't have anything since morning. Was busy in the prep. My apologies. If you hear some slurping sounds, okay. All right, so let's dive in. As always, anything that we talk here is only for your entertainment or education. Don't take it as an investment or financial advice. With that disclaimer through, let's get into the session. So let's start with the macro. It was a macro which was driving the tape this week, or rather, I would say maybe just Friday was driven by macro because before Friday, weather was all fine. Everything was cool. Everything was good. Come Friday, things completely changed. And those who have heard of saying like, hey, summer lull or sell-in may go away and, don't come back before August. Summer is not lull. Definitely this week, it wasn't. It was all the macro that was driving the tape. We got a couple of data points. One was it was FOMC meeting that happened concluded on July 31st, and then on Wednesday, as always, Chairman Jerome Powell, he came and addressed the media, took questions from media. I was listening into it, into that conference, the media call. And I mean, one thing that I would commend Jerome Powell on, that he has maintained the same composure and the same, I think, line of thought over last 2 years, right? I think everyone is trying to like extract some information. Hopefully he will leak something, but no, it's been, the same. Fed has dual mandate, inflation, unemployment. So we have to balance it. Inflation seems to be coming under control, but we want to be data dependent, and unemployment, labor market cooling down. And this was before Friday, right? So it was all the information was prior Friday. Maybe Fed knew about it, who knows? But we want to see, wait for the confirmation, or want to see more data before we even talk about or cut the rates. So one thing is cool, that they definitely looks like the rate cut will happen in September. It could be more than one. At one point of a time, he did say it, one or multiple rate cuts means more than 25 basis points, could be 50 basis points, but we'll see. So at least as of today, the rates are still unchanged, right? Now, based on what happened on Friday, there has been also murmur in the market that it's not, won't be unprecedented if, let's say, Fed do an emergency meeting and reduce the rates. But I don't want to speculate anything. But for now, it's the Fed funds rate is still 525 to 550 basis points. Job is not yet completely done on inflation. Yes, it is trending towards 2% target, but it's still around 2.48 or whatever number we saw last week. Now comes the bigger surprise, which happened on Friday. We got unemployment data, and US economy added 141,000 jobs, which was way less than 175,000 jobs that was expected, right? Which is a huge miss in terms of the number of jobs being added, right? Plus, there was a downward revision to prior months also, and unemployment rate jumped to 4.3% versus the consensus estimate was 4.1%. So labor market is cooling. Maybe some consider that maybe it is breaking, and that's why we saw sudden sell-off in the market. Oh, we are already in recession, or we are entering into recession, right? And everything sold off. Of course, the biggest losers were the high growth tech companies. So Nasdaq, I don't, maybe I think after COVID, it's the first time since COVID that on like 2 consecutive days, I'm seeing Nasdaq down like 2%. You open up your brokerage platform and you see QQQ down 2%, NDX down 2%. Like what? So yeah, a lot of sell-off, especially in the companies or the stocks that we have seen have done great so far this year. A lot of them got sold off. Including the main driver of the stock market returns last year and this year, including the king, NVIDIA. NVIDIA also sold off, even though there are no earnings that came from NVIDIA, right? But the whole, I think, for whatever reason, market participants are thinking we are entering into recession. We are into recession, and Fed is basically now behind the curve again. Fed was behind the curve to raise the interest rates because they thought, oh, inflation is transitory and we don't have to worry and raise the interest rates. Now the market is thinking that the Fed is behind the curve in reducing the interest rates, that they should have done it. They should have reduced the interest rates during the July meeting. There is no August meeting because these central bank governors across the world, they meet at Jackson Hole, have some nice wine and dine and good tea and coffee, and they just chat about it. I mean, yeah. So there's a central meeting that happen every week in Jackson Hole where they discuss policy, and that's why we don't have a Fed meeting in July. Sorry, in August. So the next Fed meeting gonna be in September, and now the market is thinking, with the labor market performing so badly as compared to the expectations, guys, are we is the economy in much worse situation? And now we'll have to wait for 2 more months before getting any, Fed rate cuts. Will we be able to survive that? If you look at really what happened in last 2 days, 3 days, it looks like everything is bad. We're not gonna survive. The companies will die. We need a rate cuts. Come on. But these knee-jerk reactions happen. I mean, this is what the market is. And like I think I put it in a Slack, don't panic. I mean, this is what a usually market does. It goes up in stairs and come down in elevator. Just that make sure you don't go too big on or too crazy on either side. Jay asked, 2 worst days feel like a bad whole week. Yeah, I have some charts which I'll share. Just expand your horizon. Things are not bad, man. This is like, despite whatever the media will show you, and media will show you the things that will make money for them, that will keep you glued to listen to them, right? And generally, that's the bad news. Bad news is too addictive. Bad news spread faster. Bad news goes viral sooner. So let's spread as much FUD as we can. 20 bips or 50 bips cut in September. I was hearing chatter from experts that it could be 50. No one knows. I don't know whether it's going to be a 25 bips or 50 bips, or who knows, we get one more employment data in August and situation changes. Maybe we may not get any rate cut, right? I don't think we as an investor can depend on saying, hey, my portfolio is dependent on Fed rate cut. So don't structure your portfolio in which you need to have a rate cut to stay invested. So market is now starting to think, and I don't know if it is priced in. Maybe we can check in terms of what's the probability of the Fed rate cut probability. Let me see if I have that Fed watch tool to see if those have changed. As of last week, it was, so let's go to probabilities. So September 500 to 525, 75%. So sorry, 78. So only 22% is probability that we may have more than more than 25 bips. Now 80%, almost 78% is still talking about 25 bips rate cut. So not changed much, but given just one job report, I don't think that's enough to change the Fed's mind. And frankly, we are still, unemployment rate is still like 4.3%, right? It's like 9. It's been up. It's better, 90% better than over last how many ever decades, right? So it's not that bad a situation. So, but if you really look at it, the core inflation is now like 2.6%. Unemployment is at 4.3%. So inflation is below the Fed projection of 2.8%. Unemployment is higher than the Fed's projection of 4%. So this is a perfect backdrop. If Fed wants to cut the Fed funds rate, this is a perfect backdrop, right? And they cut in September. There some camp is saying, hey, that's going to be a little political because you're cutting the rates too close to elections, and that would favor the incumbents. But this is a perfect background. This is a right reasons for Fed to have to cut the rate, saying now we need to focus on the other mandate, which is full employment. Right? Fed has got two mandates. No, inflation seems to be under control. Let's focus to make sure we don't kill the economy, that everyone goes out of a job. We support. We now Fed needs to support the labor market, and one way you can support the labor market is by cutting the Fed rates, make it easier for businesses to raise money. But anyway, so all charts and the numbers look to be in the direction in which it will make sense to cut the rates. But we are talking about September. That's like still 2 months away. Things could change in 2 months. So some context on this whole job, which sent the job report, which sent the market into tailspin. It is still historically low. It is lower than 90% of the time, dating back since almost 75 years. Its employment situation is still better as like of the last 75% of time. And the rise in unemployment is not that there's been more drop, but more people are now looking and searching for the jobs. So that's the two. So that got me thinking. So last week we reviewed the GDP numbers that came out to be 2.4%, which was like way higher than, I think the expectations were 1.4, 1.6. I don't recall, but we did talk about it last week when we say, hey, don't bet against US consumers, US economy grew 2.4%. But this week job numbers are lower than expected. So who's driving all this? Are these efficiency gains? Because it looks like we're employing fewer, the jobs are not growing as much as the GDP has grown. So these are like two contradictory, unless we are seeing the productivity gains, right? Now, only data, maybe we'll have to look into some more data to see if did we have a productivity gains or not. But just looking at the headline numbers, wherein the GDP grew by more than anticipated, but the job market was worse than anticipated. So how did we manage to get better outcome or a bigger output? Has to do with better efficiencies, I guess, better productivity from fewer number of people that are still employed. So we'll see. Other thing is there are now attention is getting back to some of those curves. Those are thought to be recession predictors, right? First of all, no one can predict the recession, not even the curves. But what we economists tend to do is go back and see, what is closest to prediction of a recession. So one is, of course, yield curve. And if we go back and look at the history of whenever recessions have happened, one indicator is yield curve. When you see yield curve on inverting, that's the time when we see that the economy is starting to break and the recession start to set in. And we are now seeing yield curve is starting to uninvert. By the way, yield curve had stayed inverted for very long time. So people generally say that yield curve inversion is can forecast recession, but generally it is the pace when we start to uninvert is when we start to see recession may be happening. Right?
Vivek, I asked you 3 years ago about this.
Was the yield curve?
No, inversion. Yes, correct.
Yeah. So one is, uninversion, but uninversion has been happening for some time. And the second chart I want to show is something that I learned about it maybe a few weeks ago. And then now I'm seeing it's at multiple places in media. So I learned about this SOM indicator in a podcast. And I think then 2 weeks ago, it came on CNBC. Now it has become like a staple diet when you try to predict a recession. Everyone is now talking about SOM indicator. So this indicator, it's been named after I guess, a former, or maybe she is with Fed still, an economist called Claudia Sham, and her research has indicated that if the Sham indicator is like above 0.5, then the economy is already in recession. So we go back, and I don't want to get into the details of this. This is based on unemployment data. So it is much more closer to real time than, let's say, yield curve, etc. And we talked about this SOM indicator in some of our previous session when I first learned about it. But now the SOM indicator actually hit 0.53. So now some of the talking heads or economists are saying, are we already in recession? So these are the fears that is like driving the craziness that we are seeing in the market. And of course, market was like kind of a priced. Many companies, especially the big companies, are priced for perfection. And if you and have had some good gains, right, year to date. And if you think, oh, economy is gonna go bad, and the market may not, the stocks probably will underperform, a lot of people would want to take profits, right? There's a saying, no one has gone broke taking profits. So I don't blame them for selling and maybe taking profits. But the two, I would say, if there is any reliable indicator of a recession, the two are, yield curve and SOM indicator. And right now, both of them are kind of pointing to, SOM says that we already are in recession. Yield curve uninverting. Generally, if you go back and look at the recession, you will see that the yield curve start to uninvert just before recession. So uh, more than one indicator, it's telling us about that either the recession is in or recession is imminent. And that's what spooked the markets. And we see all the bloodbath in the market on last 2 days of the week. Ross Jay says, last year, December 2023, we were talking about 5 to 6. Yeah, so we were, in fact, 7. I remember in one of the sessions, I think, or maybe in January, when market is assuming we're gonna get a 7 rate cuts, from 7 to 5 to 3 to 2 to 1, and in between maybe we'll not have anything. And then there were some talks of maybe Fed will raise the interest rates. So that is it is like futile to predict on macro level. That's why I stopped talking about macros, except when there is a FOMC meeting, or you have a like bloodbath like we had this week, when the markets are really went down just because of some macro stuff. Ross is saying GDP growth with people spending reducing, maybe government spending propping up GDP. That is possible. I think even on the employment side, a lot of uh, jobs that got added are also from a government sector. So it is possible that the growth, a lot of GDP growth may be coming from government spending. So you can look into the details. I think the BLS will have it. I haven't got into the details of that yet. Ravish, in these type of situations, when we feel we are in recession, to hedge the portfolio, should we start adding SPY put leaps to avoid big losses? So if uh, here's my thought, Ravish, is I don't buy puts, whether leaps or whether it is a short term, because it is impossible to time the market. And if you want to buy the protection over longer period, always, it doesn't help you in long term. You lose a lot more money. Go and look at a SPY and see how much does it cost to you to protect the portfolio. SPY. Okay, if I go out till December, right, which is 140 days, close to 4 months. If I do add the money, let's say center point is at $20, right? So I have to spend what come on, where's my calculator? There we go. 20 divided by 530, almost 3.75% for 4 months. Right. So that's if you annualize it, that's like more than 13, 14% for a year. Yeah, SPY doesn't return 14% average for a year. So I would, my general thought process is that if you need some money for next 2 to 3 years, don't even have that in the stock market, plain and simple, so that we don't have to do all this buying puts and all that. Will I be opposed? My better way for hedging is to maybe sell a calls or covered calls or call spreads against my position. And so that if market continues to go down, I'm continuously reducing my cost basis. But if you need something from your portfolio in next 2 years, 2 to 3 years, don't even have it in market. That's my thought process. So that's why I'm not a fan of buying puts. Doesn't help unless you would have predicted on Monday or Tuesday that this will happen on Thursday and Friday and would have bought puts at that point of a time. It's like now buying puts is like buying an insurance when the house is on fire. Doesn't make sense. I would rather have control my risk by making sure I don't have the number one, what I need for next 2 years is not in the market. Number two, my position size is okay. Number three, you are well diversified. Like I started moving into SEHD, instead of piling into all heavy growth companies, have a well diversified portfolio and then start hedging, have some hedges as well. Is my portfolio hurt? Yeah, sure. Right. You can't escape these drawdowns, but is it like, am I badly hurt and that it's like, oh guys, I'm to get out of the market? No, absolutely not. Jay says, we make money by not losing money and invest sensibly. I had to close my positions in taxable account, but bloodbath on retirement rollover. Yeah, all tech companies, all the trade that has worked so far for last 18 months has stopped working this week. Does that mean all those companies are really, really bad? We look at some of the companies, but what can happen in a day or two? Would you still hold on to Microsoft in retirement, just cash out? No, I know it is difficult to time back in. I have Microsoft in my retirement portfolio. I'm still holding on to it. I don't need retirement portfolio to work for me for next 10 years, right? 10 to 15 years. I don't need money from them in next 10 to 15 years. So why to worry? Ask Mark Cuban how he saved his portfolio buying put on Yahoo stock. Yeah, exactly. If you can, Bill Ackman made a killing in buying puts on SPY just before COVID because and then he came and cried crocodile tears on CNBC that the economy is gonna crash, and everyone panicked and crashed the economy. But then you have to time it. My problem is, and I guess majority of the folks, almost everyone, you can't time the market. You get lucky and then you can come and talk about it on CNBC that how you were so smart that you were able to time the market. But if you can't time the market, then how do you know that you have to buy puts now and not a week later? And no need to have the puts for a longer period of time. That's my concern. So that's why I'm not a big fan of buying the put. But there are a lot of stories in which, people will claim the fame of how they were able to buy the puts just before the market crash. Yeah, I'm happy for them. Good for them.
There's a cost for the put also. So yeah, you're right. A short term would be one, especially, I mean, if you're about in the market to, let's say, consider stock position, you want to buy a house or something, you might as well pay that cost of insurance. So just in case the market tanks, you at least protecting your investment in short term.
Yeah. So like I said, my way of doing that is I don't even keep it in the market. But let's say if you have in the market now, you want to protect it, or we talked about, I'm not, like I said, I'm not a big fan of buying the puts, but I won't be mad if you employ other strategies like doing collars, right? Have buffered, there are now buffered ETFs. If you don't do options, there are buffered ETFs available. You can buy, you can get the, I don't know today, because now the puts are all expensive, but since the start of this year, puts were cheaper, calls were more expensive. You could have gotten a like 100% protection at almost zero cost. But that time, no one thinks about downside. But sorry, not zero cost, zero upfront dollar amount. The cost is giving up the upside. Right? You could have made only 5% max over 1 year, but zero risk in the downside. Do a collar. I mean, we talked about collar, and I see a lot of products in the market, buffered ETFs, gap ETFs, zero risk ETFs that allow you to do exactly the same thing. So if you got, let's say, $200,000 in the market, which you need to protect for whatever reason, because that's your down payment for your house, like Jay said, then like person like me probably will not have in market, but it's fine. If then you could you rather do a collar against it, buy a protection, and get it sponsored by selling a call. There are ways to protect the portfolio. The only question is what kind of a cost you're willing to pay. There is no zero cost protection available. Only zero cost protection is don't be in the market. But then you end up paying with something else, which is your money doesn't work for you. You lose against inflation. So now, I don't know, now it's like, if you pick ATM, it's like $20. Yeah, even now also, you want to protect your portfolio till end of 20th December, you can buy an ATM put, which means zero risk on the downside, and you can get it sponsored by selling an equivalent call at around over here, right? Only 23 cents you're paying, $23 for protecting almost whatever $53,000. It's almost zero cost. What do you give up? In this case, you still have an upside of almost till 547. SPY goes up to 547. Your portfolio will still benefit from 530 to 547, but not beyond that. Now, if you already, like, SPY is still up 12%, and you think, between 537 to 547 is what? Another 2%? Is my math right? This is like 17. Another 3%? And you think that would be a great for your portfolio, that if you can get another 3%, you're like in heaven and don't want to be any more greedy, but you want to protect the downside because you got a house down payment invested in it. Yeah, you can still do it. It's almost no cost protection. But what you're giving up is, if the market rips higher because Fed comes and cut the interest rate, and the market rips higher, then you shouldn't be thinking about why the heck I limited my upside. That's a decision that you have to make. And now I'm giving you all the pros and cons of different ways of protecting portfolio. You decide what works for you. I don't like paying such a huge cost of 3% for 4 months, almost 4% for 4 months to protect. And if the market goes higher, there's no way for me to recoup this cost. All right, so I see another question. What do you think about opportunities being long-term, Boeing stock beating? Is it a good term investment? MU, I haven't looked at, I hold Boeing. That's a crap stock. Holding it for now 3-4 years, hasn't performed. But similar thesis, which I have on Boeing, is like as Intel, it's a strategically important. I don't think that as a country, we will let Boeing fail. Unless we have someone other competitor to Boeing that we in the US develop. Right now, there is no one else competing with Boeing when it comes to commercial airlines. We don't want to depend only on Airbus. And now the China is coming up with their own manufactured planes. I don't think we would like to fly in the planes that are made in China just yet. Right now, a lot of Chinese airlines, they are buying the plane manufactured by China. I mean, it's a recent news. I think it was like early this year, they started selling commercially. So now there are more than one parties, but in the US, it's only Boeing. I haven't even looked into the Boeing financials just yet. Maybe if you want it for the next week, give me the market cap and the CEO.
Okay. And same token, Vivek, maybe we can take a look at, I know Intel has been the news for wrong reasons, laying off people, bad performance, but they have a lot of funding, like $8.5 billion from the US government, $11 credit line. They're trying to manufacture in India, stuff like that. So what point do you think Intel starts looking attractive stock?
Intel has to turn around its business. I know they got a chip funding, plus they have almost $11 billion of loan. So we'll look into Intel financial. Hold your questions for Intel. I'm going to talk about Intel today.
Gotcha. Thank you.
So, all right. So that's around your portfolio and portfolio protection. There are ways to protect it. There are costs that you pay in every kind of protection. In some way, sometimes the costs are directly upfront in terms of paying through because you're buying puts. On some cases, it could be giving up the opportunity cost of giving up the upside. So you don't pay upfront anything, but you're giving giving up the upside if market doesn't fall or goes in the other direction. You have to determine what's the right cost that you will be okay with. But yes, there are ways to protect the portfolio. What else happening in the market? Market leadership is changing now. AI is not the only game in town, at least not anymore for 2 days. Let me put it that way. So good to see some more breadth in the market. So again, if you look at the drawdowns, Magnificent 7 had the max drawdown, like together they're down 30%. Right? Whereas the more a diversified ETF or diversified market, which is S&P 500, even though the majority is driven by Magnificent 7, S&P overall 500 was down only 12%. It means a lot of other stocks are still doing okay. They cushion the impact of 30% down of Magnificent 7. And if you look at equal weight S&P 500, in which you don't get special credit just because you are bigger market cap, that had a drawdown of only 5%. So still okay, right? Not that bad. And let me just pull SCHD. I don't know where SCHD is, which is mostly high yield dividend paying. Generally, they perform better when there is a what's SCHD? Yeah, it's up 5% for the year. So now market is not dead, just that there are fewer companies that have become too big, that are too big in market cap and have a decent amount of gains so far. They're just giving up those gains. But before you think of, oh gosh, I'll sell off my portfolio, I want to go back to the slide that we had looked at long back, that average returns and pullbacks since 1941, when S&P 500 gained more than 10% in the first half. So in the first half, you gain more than 10%. Average second half gain has been 7%. But that doesn't come without any pullbacks. I mean, it's not always up, right? This is how the market will go. And then as an investor, we just have to make sure when the market goes like this, we're not thrown out of the market. Right? So that when the market goes up like this, goes up back again, we are there to enjoy the gains. So there have been a pullbacks, right? First pullback, negative side, largest pullback, 5%, 9%. I don't think we even had a 9% yet, or even maybe 5%. Did we have a 5% pullback yet on S&P? If you look at SPY, this is last 1 year. Yeah, so we had like 10% max drawdown from the top of 565. But currently the drawdown is, oh, sorry, no, not that. So current drawdown is only 5.6%, not even 9%. So I think maybe here we might have had the max drawdown of 10%. So it's a 6% drawdown. And that's pretty, will be common. And 80% of the time, if your first half is positive, like above 10%, second half also returns positive. Again, these are just the stats. Doesn't really mean that this second half of 2024, it has to return positive because the chart says so. Right? Don't think in that way. But before you make any drastic decision, go and look at the data and see what has happened. These are not unprecedented events. Even though if you are in it for the first time, you might think, oh, so bad or so good, never happened before. These things happen all the time. All the time. This drawdown, this is what the market is. Otherwise, put in treasuries, be happy with 5%. You're getting 5% right now. Before Fed cut the fund rate, go ahead and put in, I think 10-year actually came down less than 4% because now we are seeing, there was a demand on Friday, but yeah, let's say close to 4%, still not bad. If you can't withstand the volatility, treasuries is there, CDs are there, bonds. I wouldn't say bonds because bonds were down 18% in 2022. But yeah, you got a treasuries. So
TLT did okay. The bond TLT did okay last week, but
yeah,
overall
because
yeah.
TLT did okay because now market pricing, maybe we'll have more than one cut. So if the interest rate goes down, TLT, which is a longer duration bond, will benefit more than the shorter duration bonds.
Absolutely.
So that's why TLT went down.
20 years, right? Longer bonds, actually. Okay.
Yeah, TLT is 20 plus.
Yeah.
So this is
Heat
what
map.
was the carpet, S&P carpet on Friday. All reds, fewer greens. Apple was surprising. It held because, after its earnings result, which we will review, almost everything red, right? Amazon like is down 9%. I think maybe Amazon closed down 10% after earnings, but more reds. By the way, this was a previous Friday. I shared this chart in last week. Everything was green. So just a week can make such a big difference. And if you let yourself be controlled by what happened in a week-to-week basis, you'll get crazy. So yesterday, I spent a lot of time in catching up on earnings and then working or something that I've been working on to help me analyze a stock and business is much better and much quicker way. So it was a very, very busy day for me yesterday because, hey, these things will happen. I just don't want to stay in front and then, become hyperactive, listening to what's happening in the market and make some stupid decisions. So best thing is to make sure that I don't have anything which is expiring on Friday, took care of those positions and then shut it down, read through earnings, and then start working on other stuff, which took me almost like till 11 p.m. But yeah, a week, previous Friday, everything was green. This Friday, everything is red. Go back to weekly performance, we get more greens, as compared to the daily one. Monthly, except the tech and the communication, The other sectors are still doing better. Move to YTD. Right? What's there to worry about? So it all depends on, hey, if you got in the market only in last 2 months, you might, or only maybe last month, you might be feeling the pinch. But if you're getting in the market, your horizon should be minimum 3 years. I generally keep it around 5 years. If you can't buy the stock that you're buying it and not give them a time at least 3 years, or if you're buying SPY, not giving it, waiting for at least 3 years, there is no business for you to buy the SPY. Don't blame if the SPY goes down. I mean, I forgot the stats, but what market goes down 10% once in 3 years anyways, on an average. We haven't had that 10% drawdown. I mean, we had it in 2022, but that doesn't mean, we will not get it in 2024. That's why minimum 3-year horizon you should have if you want to invest in the market. Otherwise, stay in fixed income or put only that money that you don't need for next 3 years. So nothing to panic. Market are still okay year to date. Microsoft is still up 9%. NVIDIA, despite all the beating that NVIDIA has taken this week, damn thing is still up more than 100%. It's up 116% year to date, right? So why complain about NVIDIA? Don't start dissing Jensen Huang. He's still done a great job. It is still up more than 150. It's up 116%. What else do you need, guys? What else do we need? Amazon is still up 10% for the year. Google up 20% for the year. So yes, these big caps are giving up some gains, but these, I mean, they had the unprecedented amount of gains that we have seen on the AI wave. Now market is coming back to senses on, will we ever see any results from AI? I don't know. I mean, it's from my perspective, I think just depending on one quarter, you're killing these stocks. First of all, these stocks shouldn't have been valued at where these were. And now you're moving completely to the other side. This is a price that we pay to earn return, which is higher than CDs. And the price is volatility. We have to go through this roller coaster ride. So better be prepared. Be prepared so that you don't have to complain later. So year to date, we're still fine, guys. S&P is up 12% year to date. And tech is still like around 20%. So just erase Friday from your memory. Life is still good. Market is still fine. Portfolio is still okay. May not be okay as compared to where it was on Monday, but it's still doing good where it was on start of the year. So pick your time period accordingly or where you want to look at. Don't look at a day-to-day basis. It doesn't really make any sense. All right. Now, fear and greed is now in fear. Now, this is a time when it's time for at least me to become a little bit bullish on the market. I'm not going to go ahead and start buying the stuff because some of the puts spreads or puts that I have are in the money. So I'll probably pick up some stocks, but I'll go a little slow on hedging. I'm not going to add more hedges right now. Maybe just recycle the current ones, maybe at a higher strike prices. Because when there's a fear in the market, again, I don't know. Could market go further down? Sure. But some part of a time, you have to take a stand saying, hey, I'll start either dipping in or, start adding hedges at whatever time period you want to pick, whenever in the market. So for me, when the market is in fear, that's the time when I would like, okay, now it's time for me to become a little more bullish on the market. So that's what probably I'm gonna focus on for the next week. So I'm not adding any huge amount of hedges right now. I'm going slow on that. So that brings up to the our next session where we're going to review a lot of stocks. So first of all, the first list that I'm going to go through is the list that you guys gave me in last week's session. So I picked up 5 from them. I want to make sure those who had requested it are there. Otherwise, I'll skip over and go to the next. And then after this section, I'm going to go and review the stocks that have had earnings this week. And that will be I guess, the only remaining portion for today's session. Today, we're going to spend a lot more time on looking at a lot of stocks. So FLYE, Cyrus had requested FLYE. Is Cyrus there or not there? I don't see his name. So, okay, I will skip it unless someone else wants me to look at FLYE. Going once, going twice. Done. I'll skip FLYE. CRWD. It was Rajiv had requested. Is Rajiv there? Okay. Yeah, Rajiv is here. All right. So let's look at CRWD. So I actually pulled the data on 27th itself, and I didn't look at what it showed. I said, I'm going to go and we'll look at it together on what the number shows. So let me just make sure I can get the latest, the PE, etc. All other are the yearly numbers. So it's going to be, I mean, it's like a new thing for me as well. We're going to look at it together, Rajiv. So let's look at trailing 12 months of a PE ratio 400 plus, super expensive. Even looking at forward PE 50, it is super expensive, but it is growing. And that's why I think market is pricing it as such a higher valuation, because PEG ratio is still like less than 1. Right, from any PS ratio, again, higher than expected, almost $3.2 billion of revenue trailing 12 months, hardly any debt, or let's say when compared to equity, very small amount of a debt, which is what I like. But on $3.2 billion of revenue, 131 million of net income, that is pretty less. And we all know, because it is investing everything and just growing the revenue. What else? Market cap $53 billion, enterprise value $50 billion. So they have more cash than debt in the balance sheet, which is what I would want to see. All right, done. Nothing. So only thing is, so far it is super expensive, is what I see. Let's look at, is it a high quality business? Gross margin, it's a tech company. So yeah, almost all tech companies have more than 60-70%. Return on investment, not yet, because they're investing into growing the business. So generally you'll see ROI when this company start to focus on the end returns, or not just growth. Right now it's focused on growth. No dividend, operating margin negative. I don't like that. Profit margin pretty average. Revenue is growing 36%. And capital light, which is fine. And they were able to have some real free cash flow last year. Looking at the Buffett metrics, spending a lot more on sales G&A. That's why they are not making any. They like 66% SG&A margin. Super. I mean, they're spending a lot more on sales and marketing, as well as R&D. This is what happens when the company is a new company. I mean, when I say new, we're comparing it with like someone who's been around for 25, 30 years, right? CrowdStrike hasn't been around for that many years. But we have only data for it for, let's say, last 8 years. Interest margin, that's interesting. Which is like operating income. Okay, so because they don't make any operating income, that's why the interest margin is higher. Net income margin very small. Tax margin higher than the corporate tax rate. Huge amount of a cash as compared to debt. That's why their debt or the interest payment is not a cause of concern, because they have a huge amount of a cash on their balance sheet. So sometimes taking on debt may be a cheaper way to finance your operations, provided you can continue to make your payments, provided your balance sheet is strong. In this case, they have enough cash. So I'm not worried about that. Yep. Let's look at over last 5 years. P has been 25. All expensive stuff. It is. So to me, all the valuation that we are currently giving to CrowdStrike is because of the fact that we think it's got a bright future ahead. The past is not that great when it comes to the numbers. It's more of a story of a future. Right? If I look at, let's say, 2 years, past 2 years, which means 2023 and 2022, all metrics super expensive. Right? So it is a growth story and being valued really high. So you have to be comfortable with that. If it doesn't grow, or if you see any kinks in its growth story, the stock should correct. So make sure your position size in your portfolio is accordingly done. It's not the company which is like returning capital or giving dividend or doing buybacks. They're putting everything that they have back into business, just trying to grow the business as fast as they can. And hence, they are super, super expensive right now, because there is almost no earnings. Right? So all the valuation is, so in any valuation, there are two components: numbers and the stories. You can't value a company just based on one thing, right? If numbers were the only thing, then all the CPAs would have been multi-billionaires. Right? No, the valuation comes from numbers and the story. In this CrowdStrike case, it's more about the story, which is driving these numbers, which is driving the pricing. Right? The traditional valuation metrics really doesn't matter for CrowdStrike. But let's say if you force me to do and see what's currently being priced in, looking at last 4 quarters of cash flow, and let's say assuming you get 4% terminal growth rate after 10 years. And let me see what's even if I say they continue to grow their free cash flow 20%, it is fairly valued at 217. Right? Not too cheap. Over past 2 years, it has grown its free cash flow at 42% CAGR. Let's see how much have they done it for past 5 years. CAGR is higher because they were not paying anything 5 years ago. So now the CAGR looks really high. But I would, let's say, give it, saying, looking at what the revenue growth, analysts are expecting 28% average for the next 5 years. They will also have to invest. And so I don't think the free cash flow will be similar to revenue growth. Even though they will, when I say free cash flow, I want to make sure that we take out the stock-based compensation, which in accounting term you do not, but that's a real cost. So I'll not give them 28%, 20%, maybe 25%, right? If you want to do that. So I guess 250, etc. is a fair value. It's not cheap. But right now, all the growth, all the stock pricing is driven by the story part of the house. And the story is attractive. I own CrowdStrike, and I think I'm gonna I have a short put spread at 250 because I thought 250, looking at a 20%, 250 is the right price to own. And it looks like it expires in August. So if it stays wherever it is right now, I'll probably will buy a little more. But remember, this is all the story of future growth. And if the company doesn't perform from a growth perspective, the stock should correct. Because the other portions that drive the valuation, like the numbers, that's not that attractive right now. So that's CrowdStrike. Let's close this. What is a good PE ratio according to you? This PE ratio is just one number, right? It depends on what sector it is. If you really want to look at, then compare with S&P 500. What's the PE of S&P is trading at? And if your stock is trading at a higher PE, then you can say it is trading at more expensive than market. Sometimes the PE of 50 or 20 could be cheaper if company is gonna grow like crazy. PE of 15 could be more expensive today if the company is going in the downward direction, if it is a dying business. So fixating on a single PE, I used to do the mistake. I don't do that anymore. I used to run the screeners of PE less than 15. Then you'll miss all the Amazons and the Mercado Libres and all the great companies of the world. So I don't do that anymore. Some companies are planning to sue CrowdStrike for recent incident. I think Delta has hired David Boise, who is a well-known lawyer in such cases. But I didn't read the report, but I saw a headline. I think one of my friends sent on a WhatsApp that legally they are not bound for. But who knows? We'll see the court cases. But is it the first time that breach has happened? So I didn't want to, since you brought up the CrowdStrike, I didn't think we'll have a time to cover it, but since you brought it up, so maybe quickly we look at CrowdStrike. Okay, I'll ignore all that. It is not the first time such outages have happened. So there are like top five outages that we have had. Right? Oops. Amazon, human typo, happened 4 hours, 17 minutes, 28 Feb. Fastly was down for 50 minutes. Meta was down for 7 hours, 11 minutes. CrowdStrike down. This was the issue was only for whatever 50 minutes, but the impact has been felt a lot more than the Google was down. So it's not the first time, but yeah, I guess if they have to pay the fine, they pay the fine. In a long term, I think it's not gonna impact if they continue to execute on what they had planned for. But I was really surprised, and maybe let's go back, because when I looked at this whole incident, I'm like, there were multiple failure points. There was a tech failure because we had a bug in the software that let the other bug go through it. The testing software had a bug. It was the process failure because it looks like they don't have a CI/CD process, which is continuous integration and continuous development. The moment you make change in any container code, it runs through the testing. You should have found it. No canary deployment, no staging, no pre-production, directly pushed in production, which is like a huge failure. Deployment process failure. You sent it to the world. Maybe you should have sent it to some set of early adopters. Watch it for a day, then send it to others. Operating system security failure. Microsoft made Windows so open that they were able to crash it. Didn't happen with Linux and the Mac OS. And of course, PR failure. They sent $10 Uber Eats coupon. So for their partners, come on. I mean, that's like adding insult to the injury, is sending $10 coupon. And then later on, that coupon stopped working because Uber thought somebody got hacked and this was like some nefarious activity going on, because they suddenly saw a lot of these coupons, people trying to encash those coupons, and they stopped working. And then finally, leadership failure. I haven't seen anyone, or a news hasn't come across me that anyone has at a leadership level has been fired, which should be. Right? So there have been, again, this is my analysis, that there have been failure at multiple levels. Let's see how they come back. I mean, their story is good, their tech is good, they need to fix the process and learn from it. So that's on CrowdStrike. Again, right now, everything is driven by the story of future currently. And the traditional valuation methods don't support that. It's fairly valued from that perspective. It's not cheap. AMD, Fred, yeah, Fred is here. So let's talk about AMD. All right, so AMD also had earnings, so kind of a mixed one. So I pulled out some earnings data. I don't own AMD as a stock, so I don't have my investing thesis document because I don't own it. But if you look at it, revenue grew 9% year over year, gross profit up 17%, operating income hugely up because in 2023 they had a negative 10, so you can ignore that. Net income up 881. So it looks like the second quarter of 2023, they were making some investments, and hence, comparatively, the income numbers in this quarter is really like blowing through the water, right? Net income 800%, EPS is up 700%, free cash flow is up 73%, which is good. Overall trends, not bad, all look fine, right? Now, if you look at 3-year CAGR, some places the story starts to break down. Last 1 year is fine. If you go back and extend your time horizon over 3 years, when it comes to EPS and cash flows and your operating income, they're actually making less money. And maybe it is because they're investing in to take advantage of the whole AI stuff. That may be a possibility. Share outstanding, almost no change, which is I like. They have not been kind of diluting the shareholders quarter over quarter. Still trading from a PE, etc. It is expensive for a company whose revenue growth has been around 8 to 9%. Right? So if we look at revenue, so here's my concern is if I look at a market cap, do I have the data for market cap? Okay, yeah, so the market cap versus revenue. Right? Revenue is growing at single digits and low single digits. Market cap is growing at like 40%, 50%. Has it already run too ahead of itself? Because if you're still spending a lot to increase, your AI and all that capacities, then you're not going to, the amount of earnings or a cash flow is not going to grow at the same pace at which your market cap has grown. So that's the one downside I see, is that the market cap has grown much higher than the real business. And is it already like moving ahead of it? Possible. So if you're trying to go in now, so let's look at a valuation. Right? Your current share price was, whenever I did this, was $133. Where is AMD now? After, it's close to 133. Okay, so assuming that it grows its free cash flow at 40%, which is very, very difficult, right? It is, that's the, from a numbers perspective, that's what is priced in. Now, if you look at a free cash flow growth over the last many years, and it's been all over the place. Negative 64%, negative 3%, 314%, 181, no free cash flow growths. So it's been all, I don't even know or figure out how much are they going to grow. Last 12 quarters, if you look at 70%, 50%, negative 71. Yeah, it's all over the places. So to me, it looks like 40% growth is asking them too much. And the market is already priced in that much amount of a free cash flow growth. So that's all about the numbers. Now let's quickly look at, from a numbers perspective, the picture is not that great. Rule of 40 is like negative 2%, negative 2. So just from a numbers perspective, not the best one that I would like to.
Vivek, what is rule of 40?
Rule of 40, now there are two different rule of 40s. I think in a VC. So the general rule of 40 is, let me give you a little background why the rule of 40 even came into picture. So majority of the time when the companies are growing, they would invest every penny into growth and don't worry about profits. So the traditional valuation methods where you want to figure out how much your free cash flow, how much is going to go in future, you don't have a free cash flow, then how do you value that? So the VCs came up with this, saying there's a rule of 40 means if you're growing your revenue by X%, then you can get some leeway on your earnings side, right? You don't make earnings, it's fine. If you're growing your revenue by 60% and you're losing 20% on net, your net income margin is 20% negative, 60 plus, and plus negative 20, that makes 40. So you pass rule of 40. So it means either you grow your revenue like crazy, then it's fine if you're losing money, or if you're not growing revenue crazy, then at least make sure you make money. So the sum total of your revenue growth plus your profit margin equal to 40 is called rule of 40. Now, there are different variations of it. Some consider it as, this net income can be gamed because you can have net income by holding billions, or like Apple will have whatever billions of dollars in treasury, you get other income. So I think in this, when I'm evaluating rule of 40, I am actually taking care of operating income. How much are you generating from your business, from your operations, right? Net income, because now if your company has an investments, the net income can vary a lot depending on what happened in the stock market. But that has nothing to do with the company's operations. So I consider rule of 40 as revenue growth plus the operating margin. There is a third variation of rule of 40, which is revenue growth plus free cash flow margin. So depending on what kind of investor you are, where you want to focus on, do you want to focus on net income, free cash flow, or operating margin? You can derive your own. So mine rule of 40 is revenue plus operating income. Right? So yeah, as long as you're not making money, but you're growing like crazy, yeah, I'll give you some pass. AMD doesn't, if it was attractive valuation, maybe I'll consider it. So right now, I think it's a lot more about the story. It's not about numbers right now. And story and the future is only, no one can predict it. If you believe in this AI story and you think that's going to be much bigger than what's priced in, sure. And thank you for bringing up AMD here, Fred, because at least I get to see this. I've never owned it and never had looked into it, but I don't want to personally own this because it's not attractive enough. I don't have any margin, except maybe I'm misreading what AI can do. And again, majority of these quality numbers are as of 2023. These are yearly number. So 2024 numbers are not in, which is fine. In a long term, I would like to, companies to perform year after year, not just in a few quarters. If story changes, maybe I'll look at it later. So that's AMD. All right. It looks like we have to rush. Right? What else? Where did my document go? Okay. Oh, I'm in the same document. I thought it was a different one. Align. Do you have Prashant here? If he is the same person that I know, then I know he's traveling. Okay, he's not here. Is Uber CS. Who gave me Uber? Is CS dialed in with a different name? Speak up, otherwise I'll skip Uber. Okay, so next week we're gonna do AFRM. I picked up only the okay. So Maritza said, let's do Uber. Okay, let's do Uber. So I'm going to do AFRM plus whatever else came in the chat with the CEO name and the market cap. I'll do Uber. For BA, you have to give me the CEO name and the market cap. So let's do Uber, because then we'll jump into earnings. A lot of earnings to cover. Again, same story on Uber. I don't know the numbers, what the numbers will reveal. So we're going to look at it together. Okay, let me pull up the latest TTM number. Should change. All right. So let's see what's in store for me. Okay, PE ratio super high. Just from an earnings side, if you are a fan of net income, you won't touch this. But like I said, PE doesn't mean much depending on an industry and company. Things could be very different. So I don't want to dig it. Let's move further. Forward PE looks like better than what was in a PE. PEG ratio is 1.24. So currently it is more priced in little higher than what the growth is, but it's not super expensive. Peter Lynch says more than 2 is when you should be worried about. Let's look at, do they have any debt? A slight amount of debt, $123 billion market cap, but not too much. $38 billion of revenue, trailing 12 months, almost $1.4 billion of net income. So actually they have a net income, which is, at least that part is good. I thought they will just growing like crazy. Gross profit, that's fine. I think 40%, 39.76. Okay. ROI, it's fine. They are not currently focused on returning. Operating margin average, that is super low. It is because they have to pay a lot to the drivers. Number two, operation, on the marketing and all those expenses. From a profitability perspective, not a great business, but they've been growing nicely and very capital light. So let's look at 5 pillars for over the last 5 years. Let's look at first 1 year. Right. Expensive to own, but have grown over 1 year. They've grown. Looks like they turned around their business because they got like free cash flow, growing their net income, operating cash flow like 400%, net income by 121%. Margins are still tight. So look, this is a low margin business. So that's why getting autonomous vehicle is very, very important, because otherwise it's from a margin perspective, not that attractive margin from a margin perspective. Let's extend to, let's say, 3 years. Story doesn't change much. Okay. So let's look at something that Buffett would consider and saying, hey, if it's a great business to own, yeah, almost 50% on SG&A, not much EPS. Cash to debt is a little less than, but I think they have a decent amount of, they have a very small amount of a debt anyway, right? What else? Retained earnings. So yeah, not from a business perspective, doesn't look to be that great, right? And I own the stock. Okay, but I own the stock, but now I need to look at and see, what should I do? I mean, is it like too expensive for me to own at this point of a time? So let's look at the valuation. Last 4 quarters of free cash flow, $4 billion. What is market price? Analysts are saying 14% revenue growth. Okay, I'll maybe give them 10, growing it at 10%. Yeah. So it's not from a free cash flow, even though the business is not growing that great from a margin profile perspective, but over the last 2 years, ever since 2 or 3 years, I think Dara took over 4 years ago, he has changed the business in which you want to make it like a more mature company, focus on profitability, returning capital, and all that stuff. So they have still been able to generate some nice free cash flow. And this has happened only last 1 year that they actually became free cash flow positive. So maybe going forward, the picture may be better. But right now, even if I give them like 10% free cash flow growth over the next 10 years, they are not super expensive. They're fairly valued. Right? Currently, it's about 58%, right? So over last 3 years, they've grown their free cash flow 49%. Analysts are projecting revenue growth to be 14% over the next 5 years. To do 12%, it's a little underweight. So I think 50, 60, I would consider it as a fair value, but the biggest concern on this one would be if someone else comes up with the robo taxis, because there is nothing much. It's like, it's not a highly profitable business. Only you can do is, reduce your cost and generate the business. Number two, there's not much of a brand affinity that you will have on this, right? I don't want to pay up for Uber service. I'd rather go to Lyft. So
Vivek, would they ever, like, if robo-taxis did go live or become a thing, would there be a play here with Uber? Like, would they become the purveyors of the robo-taxis, or would that just put them out of business?
No, I think, but then they'll have to pay for whoever is Waymo or Tesla, whoever they buy the robot taxi software from. But there's going to be a big competition. I mean, there is a value in the Uber software that they have created, but if the competition comes up with the lot of money that they have to spend is on the driver. That's why there is not much buffer available in terms of the profit margin perspective for them to compete heavily against a well-capitalized and the low-cost competitor. Right? If they partner up with, I don't know, Waymo is, I think, that the farthest ahead in autonomous driving. Tesla, I think, will go on their own. And if they partner with Waymo, it all depends on what's the terms of their partnership is, right? If it is software is more expensive or paying the drivers is more expensive. So I'll be a little careful on that front. Number two is, what's the moat they have? If autonomous taxis become the reality, then there is no moat in this business. You tell me, would you pay Uber $10 extra or rather take a Lyft? I'd rather take a Lyft. And because this is just a transactional business that I'm doing, right? I have to go from one point A to point B, and then I forget about Uber. Uber is out of my life until I have a need for the next ride. So it's a very transactional interaction that they have with their customers, and there's not much moat in the business. That's the problem. There's not much moat. So is it super expensive? But I'm not gonna and thank you for having us go through it. Looks like I don't want to own more in my portfolio now, looking at what I look now. I own Uber and have had some decent gains. And I think anything above 60 is something that I may not want to pay right now. I know stock has been all places. Stock was like 85 at some point of a time. But now looking at what I've looked at today, I don't think I would want to pay more than $60 for it. So that's Uber. Asif says Waymo is partnered with Uber in addition to their own app in SF. Oh, okay. All right, so let's move on. See, this is the beauty. So I learned something new on Uber, and I own Uber, but looks like now I have my price point or price target on where I want to buy Uber or not buy Uber. Okay, let's get into earnings. Anything else? All right, let's dive into earnings, starting with Intel. Oh my God, this is a sea of red on Intel. Revenue down 1%, year over year is down 13, 3-year CAGR is down 13%. Gross profit down 2%. Operating, okay, not going to go through all the sad situation that is happening with Intel. I guess the only thing is that the share-based compensation is less than what they've done earlier. But from a business perspective, not growing. Forget about last 1 year. Look at 3-year CAGR. Revenue has been down like 16% year after year for last 3 years. Not a bit. And this is happening at a time when the chip stocks or the chip revenues for competitors have gone through the roof.
Yeah, it's a big difference, Vivek. They are the leaders in CPUs, but not the AI chips, right?
Yeah.
And they're manufacturing as well. They're not just designing like NVIDIA or AMD.
Yeah.
That's a huge difference there.
Yeah, and their manufacturing and the design were too tightly linked that they can't even outsource it so quickly. Right. So it's like I'm gonna do everything rather than, hey, I'm gonna outsource some other stuff. Anyway, that's a history. I'm not gonna get into why it has happened, but clearly the business doesn't look to be performing, right? And now they came up and say, hey, we're gonna suspend the dividends from Q4 onwards. So all those funds that were holding Intel because, hey, at least it'll give us some dividend. Now they also don't have any reason to hold Intel because it's going to cut the dividend now. What's the dividend yield? It's 2.3%. Okay. Of course, they continue to undergo huge capex, which is what Pat Gelsinger has told when he took over CEO position, that it's in a transformation journey. So let me put it that way. Intel is trying to transform itself from just being manufacturing chips for itself to manufacture chips for everyone else. And that is a strategically an important decision for us as a country. We are all dependent on TSMC or Samsung. Right? Global foundries, they are very small. So we don't really have anything, and none of them are like US companies. So Intel has decided to become and compete and do the same work that TSMC does, is I'll manufacture, put up on fabs and manufacture chips for others as well, right? So, and manufacturing chip is not easy. I mean, doesn't happen quickly, right? You need to have a plant, you need to have physical machinery. It's not like crowd-side agent that you can just push it out. So I think if I recall correctly, they talked about $40 billion for one fab investment. So it's going to be a huge capex cycle. And now if your current revenue is not even growing, how are you going to fund it? Of course, you got some $8 or $9 billion from CHIPS Act, plus you got some loan from government. But you got to look at, sources of revenue or cut your cost. And that's what Intel is exactly doing, is laying off 15,000 employees if they really want to, turn this around. So right now it's just a turnaround story. And the only reason I still hold Intel is like a Boeing reason. Chips are important. Chips are strategically important for countries. And this is the only US manufacturer which could make chips at a large scale if any other one could, right? I don't think any other company, US company, could do it if Intel can't do it. So that's the only reason. but turning around the companies is tough and it takes a lot of time. Pat had told when he took over CEO that not even ask him any question, like give him 5 years. You have to have a patience for 5 years. We are what, second or third year into it. I think that 5 years could get extended to now 7 years. When he took CEO, he told that we will be very focused and, on continuously paying dividend. And a year later, he cut down the dividend by 60%. And now, like 2 days ago, he's like, no more dividends. I like it, which is the right thing to do. You need to conserve every amount of cash that you can scrape from your company. Cut people, it's a bad for people, employees, but sometimes you have to take the ruthless decision. Cut your cost. Don't pay any dividends. Right? Because you need that money to put in to build those fabrication plants, which then we will know how much of business will come out from that, right? So it's a really long-term growth story. I would say if you are not willing to hold it for next 5-6 years, then don't hold it for 5 minutes. Intel. This ship will take a lot of time if it turns around, and position size it accordingly. Don't go too big. I saw a post on X, which was a screenshot from Reddit, Wall Street Bets. I think a college guy got a inheritance from grandmom, some 900K inheritance. He put 700K into Intel. Go figure. So that's an Intel story. Forget about all these numbers that look really, really bad because, hey, the business hasn't been doing good. Revenue is not growing. Nothing much is working. And it's not only like, except last 2 quarters where we had 10% growth, it's been like negative 22%, -15%, -8%. So really, really need to have a long patience if you want to touch Intel. Or if it is such a small portion like mine is, it's like a dust. Hold it. But it's a little annoying.
I have a question for you.
Yeah, go ahead.
Earlier, I think when the price was around 30, I'd sold a cash secured put on Intel for a strike price of 28, expiring on 16th of August. But it hasn't been assigned yet, although the current price is well past my strike price of about 28.
Yeah, so there's still some 28 cents of extrinsic value left in it, which is almost 1/10. Of a percent. So you will get assigned soon if this goes down to, let's say, 10 cents or fact.
Right.
So now if you get, what you could do now is maybe look at, you'll get assigned, so maybe sell a call against it on 28. I mean, first of all, you have to be comfortable that you want to own Intel for next 5 years. If not, take a loss and move on.
Yeah, no, I'm okay holding.
Okay, so then, if you got 19 delta, 20 delta, you can start to scrape some, let's say even if you sell this call, let's 18-19 cents, which is more than 1% for, let's say 1.5% for next 45 days. Start selling calls against it, reduce your cost basis. That's all you can do. Or if you sell 20, so that's stuff that you can do. Or if you want to acquire more at a lower cost and willing to sell at 28, I don't know what your thesis on Intel is, but you could look at both ways. Seller put at 18, sell a call at 28. You got 58 cents, which is almost 2%. Looking at 21, it is actually more than, it's almost 3%. right? But then you'll have to buy it at 18 and let it go at 28. Letting it go at 28 won't be bad because anyway you acquired at 28 and your cost basis is less than 28. But if you're okay to buy it at 18, maybe you can look at this, selling a strangle against it. So these are things now you can do.
So thank you. And yeah, just in terms of, I was just wondering, I mean, the stocks nosedived. I was just wondering in terms of the cash that these guys are holding on their books. If, I mean, the market, do you think has the market overreacted in terms of actual valuation? So in that valuation section of your spreadsheet, if you key in the numbers, just purely numerically, is it what's a sensible holding price for this thing?
So if it is become a not the biggest concern that now we will have to have on Intel is there any doubts of it being a going concern? If it is an elevator going down, then I wouldn't like to pay any. I'm not a cigar butt investor, wherein maybe there's a one last puff left in it. So
Yeah.
let me try to suck it and enter into it before it goes completely off. That's for me, that doesn't work out. I think that now the market is really concerned. Hey, things haven't moved. Mr.
Yeah.
Gelsinger, we gave you what, 2-3 years?
Yeah. I mean, Vivek, they call it dead cat bounce. I would not bet on that.
Yeah. So if a business, I mean, stock could bounce. I'm not talking about stock. If the business they change, then I'll be willing to look into it. Right now, the business numbers are looking really horrible.
Vivek, they said this 3 years ago. Why is TSMC going to give them give them the business?
Guys, I'll believe it when it shows up in number. They recently spent what, few $100 million to buy the high NA machines from ASML. The first one came to Intel. Right. The question is, by the time they set up all their plans and everything, they're ready for the most highest end chips. Will the AI really fizzle out? You know, the semiconductor industry is a cyclical industry. And you have to be really, when it comes to a cyclical industry, you really have to be right in terms of building your capacity when the market is anticipating growth. Right now, I don't know. I mean, it's very difficult to know when this AI growth might die down. And if Intel comes up with this all like higher capacity and great, much faster chips or the high-end chips at the time when the rest of the market has soared on AI, that's going to be really, really bad. And that's a concern. I'll believe it when it shows up in numbers. Yeah, we'll change our mind. Until then, only reason for, and I think I talked about earlier also, it's not the first time, only reason I'm holding Intel, it's strategically important, right? Uncle Sam. But then I can't bet my house on Uncle Sam.
Yeah.
Or
I
won't even bet my lunch money. Maybe a little bit of breakfast, a few cookies, yeah.
Maybe if you want to buy some rental properties in Ohio, Arizona, whatever they're investing in, that might be a place to, just traveling nurses or something like that, because if you're investing out of state. But this 5-year plan, I mean, the Biden administration has been kind of blessed Intel right now, but things can change pretty fast with the Trump or anybody else coming to power.
Yeah. And even that one, I think I heard on the TSMC, maybe you, Jay, you are in real estate, you probably know much more than I would, but I think I read some article wherever the TSMC is putting a plant in US, the home prices went high and a lot of people bought in, and now which has come down again because I think TSMC's plans have getting extended and all that stuff. So nothing is without risk anyway. So you have to be really careful in terms of what you want to do.
Yeah. And just this also goes on to prove, because I mean, the CEO is an Intel sort of born and bred, right? And has been working there since he was 18 years old, really intelligent guy.
Yeah.
And is an engineer. So, I mean, gets it from bottom up. So yeah, it's just an interesting dynamic that's played out
So-
here.
Yeah. So
Absolutely.
thing is that, hey, if anyone can turn around, people say it's going to be pat. But
Yeah.
can anyone turn around this ship? Has it already gone too far? Has it gone too adrift? That's the question. And it's not going to be easy. It's going to need a lot of money to turn it around.
Absolutely.
All
Yeah.
right.
And at the end of the day, Vivek, it is all about opportunity cost also, right? Where you can put the money to get the most bang. I mean, Intel, I wouldn't count them out altogether. They've been the leaders out there, but again, maybe not right now. And for that matter, is same thing, right? If you're trading and you're just kind of not making any money and you feel scared, I might as well sit a week out of this market and then trade when I feel a little more confident making some kind of positions with hedging.
Yeah, so when I say opportunity cost, I think you're talking about opportunity cost from an investor perspective. I'm looking at what's the other thing that Intel can do, or do they have any other optionality? I
Mhm.
don't think it's in Intel's DNA to move out of chips. Intel now is gonna create a social media app. So what else can they do on a chips? Which is what I think they are trying to do is, hey, let's make chips for others as well.
Yeah.
Asif said they can sell burgers. So I don't see much optionality in terms of if Intel is not doing, I don't know. Again, I'm not too close to this sector, and I don't even have an investing thesis document on Intel because it's such a small portion and I never spent time. I think the time that I spent today on talk about Intel, that's the maximum time I have spent. So don't take my words as a wisdom, but this is my general thesis on Intel.
I
Again,
mean, we read on the books, right? Just look at solid fundamental companies who've been really beaten down and try to earn that. But again, that becomes a question, right? Why they beaten down and what's going to happen? Because there's a reason they're down. It could further go down as well.
yeah. Things that are down 90% can fall down another 90%. I don't think Intel is now 90%, but it had its worst fall since 1970s, is what I heard. Anyway, let's move on, guys. We got a lot to cover. Okay, a lot to cover. Snap. So I look again, I didn't have a time to go through the Snap report, so don't have my document yet. But quickly morning, I just took a snapshot. I'm like, numbers look okay year-over-year basis. Or I think Snap is down. There's a competition. Again, I hold Snap in my portfolio. There's a competition between Snap and Intel between who can fall more. And I guess Intel won the crown at the end of a day, but both are like more than 20%. But today morning, when I looked at this for today's session, I'm like, year-over-year revenue grew 16%, gross profit up 13%, operating income still negative. They never made money. That's why I hate them from that perspective. But they lost less this quarter. Net income lost less. Operating cash flow lost less. EPS diluted lost less. So which is all good. Right? Less of a negative is better. I'm like, what the heck happened? So why the stock got punished? Then I looked at, maybe I think it's all about expectations. From a year, quarter-over-quarter basis, they did good. 3-year CAGR, yes, in terms of a revenue, 8%. Right? 3-year CAGR, 8%. Now, if as an investor, if I were to look at it, are there other social media apps which are growing faster? Yes, I will talk about one today. So I think it's all about expectations. My personal opinion, again, I have not spent more than, I would say, 5 minutes in pulling this data and writing this. The quarter numbers are not bad compared to year-over-year, but I think it's lower than what Street was expecting. Street was expecting 1.25 billion. They came up with 1.237 billion. Is it that bad? How much stock was down? Like 25% or what? Is it like 25% bad? Oh, the charge. 26.93%, 27%. Right. Guidance was also light. So Snap told us that they gave a guidance 1.335 billion to 1.37 billion, 75 billion. Analysts were expecting 1.36 billion. So I don't really know. Again, if you had looked at Snap, share because I spent only 5 minutes today morning because of vendor earnings, but I don't see really anything bad out. Anything as 27% bad out here. Could it be possible that the stock had already run up so high, it was already highly overvalued? Maybe, that may be a possibility. But just because there is a slight miss, but this is what Mr. Market does anyway, right? That they'll swing too hard on both sides. Snap meets the guidance, they'll be up like 20%. And it is a volatile stock. It is down 27%. Last quarter, it was up 27%. Prior quarter, it was down 35%. Right? This is what it does. So you can always count on Snap making huge moves after earnings. So then I took this screenshot. Clearly not a good business. It's all growth story related to social media. So you do what you want to do with a stock, but assuming that it was fairly valued, again, I don't know, I didn't run through the valuation. Assuming if it was a fairly valued before earnings, I don't think earnings was 27% crushingly bad. That's my only, I would say, piece of knowledge or information that I gained from looking at earnings number. Not that bad. Maybe it got carried away with the rest of the stuff that is happening in market. That may be possible. But if you like, or you want to own Snap, it's not the best business to own, but who cares? Everyone want to gamble and you're free. It's a free country. If you want to gamble Snap, just this week's reaction might give you an opportunity. Look at it. If it is a valuation, I mean, you can't do any cash flow valuation because it doesn't generate any cash flow. It's all about story. Right? I've yet to read it's a quarterly report, so I don't even know what management talked about it in the quarterly report. All right, moving on to the next one, MELI, Mercado Libre. This is my biggest, or not, if not the biggest, second biggest individual stock. So of course there's my document on it. So let's look at Mercado Libre. Revenue up almost 49% to 5.07. It was beat. Net income up more than 100%. EPS diluted up 100%, which was beat. So the beat on revenue as well as EPS, both are impressive growth. There was a strong growth in Brazil and Mexico. If any of you recall last quarter review, we said they are investing in Brazil and Mexico, and that's why they had to, their operating income was less because they were building warehouse in Mexico and Brazil. Market didn't like it. I thought it was maybe it was last quarter before that. Stock got punished. I didn't see anything bad in it, guys. You have to invest. If you're an e-commerce company, you have to build warehouses. And now those warehouses are paid off this quarter with the business showing pretty impressive numbers. Their KPIs wise, GMV up 20%. Take rate is up like more than 5%, which is really good take rate. So like almost 25% take rate, which is really huge, right? So I really like from that perspective. Then of course their payment business is all up. Credit business is up 51%, wherein they give loans. Number of items sold is up 30%. Buyers are up 20%. Fintech users are up 15%. There's nothing not to like in this quarterly business, right? 50% year-over-year growth in revenue for our e-commerce. I mean, it's a growing e-commerce company. So what else? Fintech MU surpassed 50 million for the first time in its history, and it's been around for 25 years. Yesterday was the birthday. Yeah, yesterday was his birthday. So I kind of cheekily, I tweeted it on, I still call it Twitter. Wish them happy birthday. And the number of buyers that purchase goods in 3 or more categories have reached a new record. So not only that they're increasing the number of unique buyers, each individual buyers are now buying more stuff in more categories from them, which is what you would want to see. Quick updates on e-commerce side. Now they opened a warehouse in Texas to basically supply the goods from American suppliers to the Mexican consumers. So now we're going the other way around. So generally, America imports stuff. Mercado Libre is setting up a warehouse in Texas so they can export for Mexican customers who want US goods. They'll be able to export it. Brazil and Mexico is growing as anticipated earlier, and now those investments are paying off. So if you had taken advantage of when market didn't like this investment, there's an opportunity to pick some shares. Brazil grew 51% USD growth year over year, and Mexico grew 66%. Right? There are individual businesses, which one I should talk about? I mean, everything is good. There are payment business, which is what you want to keep an eye on. It could become a huge, huge business. Credit business, non-performing loans did better, which is what I would want to see. Now they're getting into insurance. You buy goods, you also buy insurance, warranty kind of a stuff, which was up. Policies were up like 100% year over year. I just have to see. They didn't share any information who's the partner. I hope that they are not managing everything. They're just partnering with someone, which is generally what a big retailers will do. So while the policies may grew 100% year over year, the actual revenue may not impact that much. Logistics, there was an increase in cost because they're investing in the infrastructure for MELI Plus and all that stuff, new stuff. That's what I want to pay attention to. Their ad business. No one talks about ad business. They don't even mention it separately. You have to really dig through their report to even see what their ad business is as part of their GMV. It doesn't show up in the metrics that they show. Maybe they will start to show it when it becomes much bigger business. Right? But that's where the beauty lies is if you really want to invest, read these reports, you can know about some of these dark horses way before the rest of the market knows about it. Like YouTube for Google, ad business for Amazon. We started talking about ad business for Amazon quarters before the CNBC started talking about it because, hey, you read it in the report and you see, this is a small business, but it's growing quarter over quarter. So now I'm seeing that on ad business is growing 50% year over year. They don't break it out yet. The overall revenue, Mercado Libre does a great job in showing you all the metrics, but the ad revenue is still not there. So you still have to find it, dig deeper in the report. What I liked about it is, again, buried somewhere in the report, I saw this. There were, since start of July, like a month ago, they're working on a development of an off-platform ad business. And they have a partnership with Disney Plus, in which basically they become an ad exchange to serve a programmatic ad. So we generally know Mercado Libre as Amazon, PayPal, eBay of Latin America. Is it going to become a trade desk of Latin America? I don't know. This is just something that we need to keep an eye on. I want to keep an eye on if this business takes off or not. Maybe it'll just die down. It has just started, which is the off-platform ad business. Their own platform ad is doing good. It's growing 50% year over year. Still not a meaningful revenue to report it separately, but you never know. A year down the line, it becomes a few billion-dollar business. Market will start to talk about it. Yeah. Guidance company don't offer guidance. Stock reaction market loved the growth in the business. Stock was up like almost $200 after hours. Some $1,800. I don't know Friday, where did it finish? 1775. Oh yeah, closed at 11% up after earnings. Not bad, not bad. So this was one, and since this is like one of my biggest positions, it helped me, gave me some cushion for the Friday bloodbath. So all metrics look at comparison year over year, 3 years. I mean, it's just a business execution, right? At the end of the day, it's a business execution, nothing else. Business metrics, they all look great. Trend over last 12 quarters, right to the up, right to the up. And then I run through valuation. Except the valuation numbers, right? Most of the things look good. It is not available cheaper, but it's a good revenue CAGR. They got a operating because it's an e-commerce retailer, so I don't expect them to have a higher operating margin. Like Amazon, if you take out AWS, will have a very less operating margin, but checks a lot of boxes for me. And 50% on rule of 40 and still growing like almost 40%, 50% quarter over quarter. There's nothing that I don't like in this report. Any questions on Mercado Libre? I'm a happy shareholder. Who?
What's a good value to own it at?
I'll have to check on the valuation front, but I think here's my take on it is right now, anything below 1600, I'll buy it. And I have to check after recently what's the kind of a valuation is market according, putting it. But it's a great business to own irrespective. If we have next 5-7 years of horizon, I will buy it today. If it is not a part of a big position. For me, it's already if not the biggest, the second biggest individual stock in my portfolio. Let's talk about Amazon. All right, this detailed review helpful, or shall I just skim over it? It depends on what kind of a investor you are. At least for some of the big positions, I get into the details, but if you say it's too boring, let's move on. We can do a quick overview numbers and move on. Like I have for some where I don't own stocks or I haven't got my document in place yet. So what happened to Amazon? Revenue was
Details, wonderful, thank you.
Oh, you're welcome. Cool. All right, so revenue was up 10%, but missed by 0.5%. Every other metric looked good. Profit margin up, gross margin, operating income up like 91%, operating margin, net income, everything up. EPS up 100% almost. But and they had beat on EPS. So what gave Amazon is like down 10%. It's all about expectations game. So operating income, cash flow, net income, everything grew nicely despite the investments they have made in AI infrastructure to date. Right? Still, they were able to grow their income side of the house. EBIT estimate they beat by 8%. EPS almost doubled. CapEx up 54%. Spending a lot. So if they had not spent so much, they would have had more impressive margin profile. Free cash flow is 53 billion, like last trailing 12 months. So Amazon is known for just investing into business. But now kind of a turning around and able to generate some free cash flow. But after 30 years in the business, yeah, that's where the businesses start to mature. Right? So business metrics, what I liked about advertising services grew 20%. This was a dark horse. Now it has become a meaningful part of overall business. It's like a $12 billion, it's like $50 billion run rate business. $50 billion run rate business that no one talked about. We didn't even know like 4 years ago. So it grew 20%, but Street was expecting 21.6% growth. So two misses: missed on overall revenue, miss on growth in advertising revenue. AWS net sales grew 19%, but you compare with Google and Microsoft, they are like close to 30%. Street was expecting less, so I guess this is a nice beat, not beta. And operating expenses grew 1%. Something wrong. It shouldn't be 1%. It has to be more than, no. So I think the operating leverage doesn't apply here, or not on the AWS side. That comment should be over here. So operating leverage is when your operating margin, your operating income is growing at much faster pace than your revenue, which was the case here. Revenue grew up only 10%, operating income was 90%. So anyway, so even though the revenue, I guess, could apply here, even though the revenue grew 20%, the cost grew only 1%. So yeah, there is a kind of operating leverage. So everything looks, to me, year over year or 3 year, looks to be fine. Right. AWS and advertising are the two businesses that are growing 20% year over year. Online store grew only 5%, which is what the huge concern is. So stock got sold off, and I guess on 2 or 3, maybe I have a reaction here. Yeah, so 2 or 3 things. Number one, their guidance was only 9% growth. Market didn't like it. Oh, sorry. Yeah, their guidance was not strong, so market didn't like it. Number two, that their online store is only grew 5% because, they told that consumer is stretched. And that's where you start to get the worries of recession. Oh my God, consumer is now not spending anymore on Amazon. They only grew 5% year over year. That's not good. If it was no advertising or AWS, then it's not that great a company to own. It's only grew their revenue from 5% from their e-commerce business. I think that was a concern. It's sold off. Third is they also told the CapEx continued to go high in second half to build the capabilities for AI. Right? It's all about the future expectation. It's about the meeting expectations of the Wall Street, which looks like they were a little short on a couple of items. So market reacted negatively to it. I don't see any, okay, if there are any weakness in the business that hasn't yet really showing up, growing 10% when you're like doing $600 billion revenue run rate, and you're still growing it at a 10% year over year, it's a decent one. Not that bad. So I'll skip that chart. So net sales, their guidance was between 8% to 11%, which is what market didn't like it. Street was expecting some, 1.3% more. And then operating income was way below street expectation because they're going to invest more to build capability for AI. And hence the operating income will grow much less than what street was expecting. Now you can decide for yourself. Is it a good thing to invest so that you are ready to cash on those investments when AI takes off? Or do you think if AI is already, I don't think AI is gonna take off, or it's gonna be a future business generating stuff. So any investments are not good. That you have to think. But that's what market kind of crashed the stock. Is down like 10%. I'll skip. What else? I think everything else is fine. SBUX. Keep an eye on the SBUX. Okay, nobody's talking about it. But they're deploying their fleet on public roads. I, in fact, spoke to an Amazon employee 2-3 months ago to get some, and we discuss around SBUX. And I want to keep an eye on that. Today, we only think Waymo and Tesla, but this could be a new player it might be just for their, who knows, if only for their internal, let's say, delivering packages is gonna blow the margins through the roof. Or if it becomes a robo-taxi, which I don't think, but Amazon has gone into multiple places. So Amazon could move into robo-taxis, who knows? But something to keep an eye on is Zoox. Again, very early in the cycle, but they are now deploying their fleet in more and more cities. But I don't see any chatter in the market about Zoox. So capital allocation, I didn't see anything on share repurchase or dividend. Market is, my thoughts, market is reacting with short-term focus. Main growth engines are advertising and AWS, and both have done well this quarter. The CapEx is what market didn't like it. I'll probably take advantage and add a little more to my portfolio when I run through the metrics. It is expensive. It has never been cheaper, right? It is an expensive stock to own, but if anyone can still continue to deliver, Amazon has proven that they can. But it's always been an expensive stock to own. Let me put it that way. So, okay, that's a next one. So that's on Amazon. So I'll probably buy it at what it's now at 160, 165 or something. Not a financial advice, but that's just me. All right,
Vivek, do you remember when the stock was at $15?
Don't ask me. I wasn't doing anything in the markets then.
Yeah, I think it was 35 years ago.
Yeah, so, but I had such a tough time in buying Amazon because I saw it. I think I saw it first when it was at 250. There was a pre-split. Then became 600, 800. I eventually took a courage to buy the stock at 1600. That was my first buy in Amazon. And it still has worked fine. So if you buy a great businesses that have been performing and you think you missed the boat, no. The concern happens when we are buying it and we don't know, is the business is sustainable? Do they have a moat? Can they expand? Amazon has such a great optionality. And then because we don't have that runway, we want the stock to perform immediately. I buy it today, tomorrow it should be up. I don't have a patience, right? Or day after tomorrow, week, I want to see it up. As an investor, I want to focus on, hey, is the business doing great? And even if it is a little expensive, as I bought at 1600, still fine. Well, that was like post-split, it is what, $80? Too late to buy at $80 when it was available at like single digits for many years, right? But still has worked out well. That's not too far away, like $1,600. I think I got it in Amazon in 2017, 18-ish kind of a time frame, whenever it was like around 1600. But I think it's good that I got into it. It's a very difficult decision when you've seen it going from 200, 300, and you feel like a stupid, why didn't I buy it? So you have to bite the bullet, keep your ego aside, say, yeah, I was stupid. I didn't buy it at 300, but I'm going to buy it at 1600, which is what I did. Anyway, let's talk about Apple. So I didn't have a time to go through the details, but I'll just pull up those, like the numbers. Revenue up 5% only. The only difference is after almost no growth or the almost a reduction in revenue quarter over quarter, now it has turned positive, 5%. Right? And everything else, I think, is fine. It's a huge business, so you can't expect it to be growing like 30, 40%. Right? It's already such a big, from a business perspective. Gross profit is up 9%. I think let's talk about it's an expectations game, right? So they beat EPS. 1.35 was expected. They delivered 1.4. Let me take this up so that we don't have to scroll down. Revenue $84.53 billion expected. They did 84.5, 85.7, beat. iPhone revenue beat, services beat. China is down 6.5% year over year. As you can see, whereas China is down almost 6.5% or 7% year over year. US is up 6%, which is great. And I think the silver lining is two things. One is, of course, the services up 14%. And it is almost $100 billion revenue. I think before 2019, they didn't even used to break up services. So services like one of those dark horse. Now it's $100 billion revenue. And Asia Pac, rest of Asia Pac, except Japan and China, grew 13%. So Apple is finding, or they are bringing up the product at the product pricing, which is attractive to the other developing countries also, because that business grew almost 13% quarter over quarter. Right? So I think it's more about the expectations are so low because Apple revenue has been like -1%, -1%, 2%, -4%, that a 5% seemed like a huge deal, right? So it's a very low expectations were there, and hence stock did what it did. And their cash pile is now $153 billion. It's down from 163. What $10 billion among friends doesn't matter, but still a huge cash that they hold on their balance sheet. I see a question. Warren Buffett halves stake in Apple. Oh, today was a Berkshire. This is today's 2 hours ago.
Yeah. Today's that's Financial Times headline right now.
Okay, cool. I mean, how you do it? It was already more than 50% of his investment portfolio, and now Apple has already gone high over between the last quarter and this quarter. If we, as a responsible, so Q1, right? Sorry, Q1 is, I'm looking at Apple. Oh yeah, so it's close to Q1 is around here. End of a Q1 when Apple was trading at $170, it was more than 50% of Berkshire portfolio. Since then, it has moved up to $210, $215 at the end of June, right? Which means it would have become another like 10, 15% higher. Too much risk in one stock. Don't care even if it is Apple. Right? Berkshire Hathaway is managing money for a lot of other people, right? So I think I'm not too concerned about it. Even previous quarter also, Berkshire sold shares of Apple, right? If you recall, not half, but they did trim their Apple position. So I guess even after this, what I want to know is even after this trimming, how big is it a part of a portfolio? Is it like 5% of portfolio? Then I'm a little concerned about it. But if it is 25%, 30%, 40%, still a huge position. If Apple revenue growth is so low, why such a huge multiple? It's freakingly cash generating business. It doesn't know what to do with its cash. $100 billion of a free cash flow means after all investments have been done, this business generates a lot of cash. That is why it is still valued, and it's not available at cheap valuation. Look at Apple, its valuation is not cheap. By no means it's a cheap stock. But then, man, amount of cash that they generate, it's huge. Right? And number two is right now, market is all, I think, positive about the upgrade cycle with the AI. And I know AI is not going to be 100% on when they release a phone, but those phones will get updated with a newer AI software. So that's the reason market is still paying premium for such a good business. You don't always have to grow revenue. Unfortunately, many of our growth investors only focus on revenue, which is what I also used to do. But if you look at revenue and return on invested capital, those two should determine how you want to invest in stock. So I'll be okay to invest in a stock. Revenue grows 5% only, but if the return on invested capital is huge, it can still generate a lot of cash for me. Whereas let's say revenue growth 20%, 30%, return on invested capital is only 2%, business is not generating enough for me. For Apple, ROIC is like 40%, 50%. It's a freakingly very good business. It's a cash generation machine. So I don't want to bet against $100 billion of free cash flow. That's the reason why it is that on a valuation front, it looks expensive, but boy, it generates a lot of cash. Okay, quickly Square, the document, but I did tweet about it. So let's go through that. So what happened on Square, now known as Block? Revenue up 11%. It was a miss. But if we exclude the Bitcoin, because Bitcoin, again, revenue is, the Bitcoin contributes a lot in revenue, not much in profits. Because they only earn a small amount of a commission, right? But the value of Bitcoin comes in revenue. So I think from an operations perspective, we should look at excluding Bitcoin revenue. It grew 13%, right? Gross profit beat, gross margin beat, operating income up like 300%, operating margin 7% higher to from negative to positive. Net income is up like 300%, whatever, to say huge numbers. And all because Jack Dorsey told, right, we're gonna tighten our belt. They've been very focused on execution. Subscription and services revenue grew 22% year over year. Cash App user transaction was a modest one, but inflows was up 15%. I think across the board, it was a good performance. I was almost had put Block in my penalty box. That was the next stock which I thought, okay, I need to, start aggressively selling calls against it. But looks like looking at this quarter number, maybe it might allow me to change my mind. Because when I run it through the business metrics, not a great business to own. And I own it. I've owned for a few years. But they've been just burning cash. I mean, let's not go through all of this, but I think from this quarter, looks good. And if they continue to perform the same way, I might as well want to be more willing to hold Block in my portfolio. They bought 173 Bitcoins and now have close to 8,000 Bitcoins on their balance sheet. Increase its guidance and is better than what the street was expecting, both in terms of their yearly guidance. I think it was a yearly guidance. So they increased on all front. Gross profit guided up, increased it from a previous one. Adjusted EBITDA guided up. Adjusted operating income, they guided up. A rule of 40, they'll be at 35. Right? So maybe they are turning it around. Who knows? Capital allocation, from a prior authorization of $1 billion, they still have $202 million remaining. This quarter, the board has authorized 3 times more, like $3 billion to do buyback. If management is prudent, maybe they're thinking stock is too undervalued, that they now want to go and aggressively buy the stock. Maybe it is undervalued. Right? Who knows? Management thinks. But the previous buyback happened at price of 70. That didn't turn out to be the best move. Do you think they'll do better this time? Will they buy back at a much cheaper price? Whatever its stock is currently at. Where's the stock is trading at? I know after earnings, it went up high. Stock is at It eventually closed like nothing burger, $60. So I still hold stock in portfolio. Look at my average buy price. Crazy. But my current cost base is 111, still like cut into half. Thankfully, not a huge part of my portfolio, but I'll hold it. I'll still hold it. I think this quarter has changed a little bit my thesis. Maybe they are turning the ship around. I'll wait for another quarter or two before I become aggressive in selling covered calls. I might give myself a little more room to sell a covered calls and not go too aggressive if they're turning the ship around. So that's stock. Let's look at the new one, ANET. So as you guys know, ANET is the new stock that I own. I haven't have the doc yet prepared, but very recent position. And we talked about it. I've started to read its annual report and all that stuff. We'll update the doc with that thesis, but quick look at the earnings. Revenue up, gross profit margin, all up. No concerns. 3-year, year-over-year, numbers all look good. The CapEx is down, whereas everyone else is like, and they're still able to grow the revenue 16% year-over-year, 34% CAGR. CapEx down could be only one area where I might think is that, hey, are you kind of not preparing yourself for future, or will you be left behind? That's one area I need to double click on. But other than that, business performance look good. And look at this. Right? Except valuation, it checks all the boxes. Even Amazon didn't have all these boxes checked in. So I don't know. I mean, and thank for whoever brought up Arista Network on in this meeting and put it on my radar. I think now I did my feed in it, but as I learn more about it, looking at the numbers look all great. I have to know about the story, right? For that, I have to go through what the CEO and they have to say, go through some earnings report. Numbers, I don't think I've seen any company in my portfolio which has got such a attractive from a numbers perspective. Margins, growth, return on invested capital. I mean, much better than many of the other companies I own from a quality of business perspective. Only thing that is concerned is valuation is higher. I'm looking at the last 5-year average. So it's not like, hey, it's been only last 1 year because of AI. It's like last 5-year average. Operating cash flow growing at 32% CAGR. Gross margin average is 63%. Market cap grew only 36%. I mean, yeah, so I'll see. I looked at the last 10 years of data, right? Just to see, is it only like flash in the pan? I don't know. I mean, there's nothing not to like in it. So numbers, fine. I need to know about the story before I increase my position size in Arista Network. This quarter was also all good. I've yet to study the details of business, but so I did ran some, hey, if I price, so right now, 20% free cash flow growth is priced in. If I look at analyst projections for their EPS and revenue, that's around between 17 to 19%. I give it 18%, right? $300, right? So I'm like, okay, I'm going to buy below 305. So sell a put spread with $300, or I don't know, maybe I have a 300 or 310, somewhere near it. I have a put spread, and then I have a call spread, which is way higher. If it falls down, and I wish it falls down, because when I bought it, it went up high. I'm like, dude, I haven't yet buying my full position. Hold on, please fall down so that I can complete my study. And if I really like your story, I'll buy more at a cheaper. But that's Arista. Sorry, I don't have much details around business. I'm still trying to learn about it. Yeah, she worked at Cisco, and the few things which I learned is another co-founder was a co-founder of Sun Microsystem. Andy don't ask me to pronounce his second, Bolchestein, whoever. So when I read his name, I'm like, I have known this name. Then I realized, oh, he was a co-founder of Sun Microsystems. So far, big one risk that I found, which will hold me back, is concentration. 2 customers account for more than 40% of their revenue, Meta and Microsoft. That's a big risk. Okay, Starbucks. I know we are almost 30 minutes over. Starbucks, revenue down, everything business-wise not look good. They opened 1,600 new stores and still the revenue is down. So market doesn't really like it. Same store fell 2%. Overall, China 14% down. Luckin Coffee is eating its coffee. That's a bad. They also launched a new type of drink, like boba tea kind of a drink. CEO is saying efficiency, efficiency, efficiency. So if you want to go and sit in Starbucks for 2-3 hours, they may not allow you to do that anymore. I'm just kidding. But the experience is not that great anymore, what it used to be. So if you're gonna water down the experience, should I really want to pay up for your coffee? I don't know. So I think they really need to do something different to turn the ship around. They have a brand power, but they need to execute on operational side and give the experience. This quarter over last 3-year CAGR numbers are not encouraging. So stock is down. You may consider it as a value play. I would rather wait for business to at least turn around. Could be value trap.
In China, Starbucks had from like 2018 or 17, it had always been going down. It's I mean, Luckin is not a brand. I mean,
Yeah.
it is a brand, but it's like Kmart compared to, you know what Kmart is, right?
Yeah. So, but I mean, Luckin is growing. The company that was accused once of fraud and was kind of went to the over-the-counter market, now has come back up.
Yeah. I mean, the IPO was about 19-ish. Now it's at 22.
Yeah. So anyway, so I just looked at some numbers, looking at the valuation metrics and all that. Free cash flow perspective, 11% is priced in growth in free cash flow. To me, it looks like a value play if only management can turn this ship around. So I don't own Starbucks. I'm not rushing to buy Starbucks. I want management to perform. The valuation perspective, it is not expensive from free cash flow perspective. But if they want to invest more to grow the revenue, then you may not see that much of a free cash flow, right? It is fairly valued. It's not cheap. Stock is not cheap, but it's not too expensive also. Okay. So that's oh gosh. Okay. 3 more. You guys have a patience for another, guess 15 minutes? We got 3 more to cover. Okay, so let's quickly go through it. Pinterest. Do we have the document open for Pinterest? Yes. Revenue up 21%, gross profit 24%, margins up, operating income up 71%. They beat on revenue as well as beat on EPS. So this quarter, great execution. Net income up more than 100%. Cash flow up like 700%. Right. So all around, it's a great execution from a business perspective. KPIs also look all good, right? And they also beat on global MAU numbers. They beat on revenue, beat on EPS, beat on global MAU. Quarter-on-quarter comparison, all good, right? Only thing I didn't like was increase in share SBC. They like 16% more shares were, more value of shares were issued to employees. They are diluting me as a shareholder, okay? But if you're able to generate net free cash flow, even after giving $196 million as a stock-based compensation, okay, I won't complain. I won't bitch and moan about it much, okay? But $2.7 billion balance sheet, which is good, a very small. Yeah, long-term liability is very less, so which is fine. Balance sheet is strong. Looking at the business KPIs, global MAU, which is monthly active users, is up 17%. Good growth in Europe ARPU, average revenue per user, 43%. Even US and Canada grew 12% average revenue per user. So not only that they've grown the user base, they've also grown the average revenue that they can get from users. Guidance, they're guiding to 16 to 18% year-over-year growth. For Q3, they grew 21% in this quarter. Man, market puked on it. They didn't like the revenue growth. They were expecting 907 million, and even the top end of the guidance was below that. So it's all about expectations. And when it comes to the daily stock movements, it's all about expectations, right? So stock was down like 11% because of this guidance. What else? My thoughts: company beat on revenue, EPS, and active user metrics. These are the metrics that you would want to see, and with higher ARPU, right? These are the metrics I would want to see. No, these are all going in the right direction. Guidance was weak, so the stock got punished. So of course the stock doesn't trade cheaply. So any weakness, you'll get punished when you don't meet the street expectations. So key metrics that I want to watch it, both growth in MAUs and ARPUs. Company had done right on both the fronts. I'll hold the shares and continue to reduce the cost basis. It's a turnaround story. Numbers wise, not that great when you look from a traditional valuation numbers, but story wise, I think I can still hold it. They are turning it around. Bill Reddy, the new CEO, I don't think if I call him new anymore. He's been around for now more than a year or maybe 2 years. He came from Google. He's doing some good things. Does anyone here use Pinterest? Is there anything you use them specifically for? I don't use Pinterest, but I don't use Facebook also. So, but we know what Meta is doing. They got more than half a population, but they have a 522 million active users. So probably a lot of people use it. So that's Pinterest. Let's talk about Meta.
I was just curious if they do something that other things don't, but I understand that can be a hard question to answer.
I mean, so Pinterest is the only social media where you don't find ads as intrusive one. So I was always at a concern of how the heck they are not able to monetize this. You want to go to Pinterest to see ads. I don't want to see ads on Twitter because it's intrusive to my experience. You'll see some sponsored tweets, which I was thinking, oh, it's a news. Then, oh no, it's a hedge fund. Someone is trying to sell a software. It's intrusive. Pinterest, you want to see those ads. Those are a part of experience, but the prior management didn't really exactly know how to monetize it. So I want to give Bill Reddy some time. He came from the right background. He's doing the right things. And now I want to give him some time to turn the ship around. It's a turnaround story. That's why I say it's a turnaround story. Okay, so quick Meta. There's a lot to like. Beat on revenue, operating income up 60%, net income 73%, EPS is 73%, operating leverage is there. Strong balance sheet, $58 billion of cash and cash equivalents, right? It's not just luck. Look at 3 years. For Meta, I went back 5 years. And everything looks so, even for 5 years, you're talking about a company that is generating what, more than $100 billion in revenue, growing at 22% year over year. that's the problem when Pinterest comes and say, I'm going to generate only at 18%. Or Snap is telling them, I'm going to generate revenue only at X%. Right? When a company like Meta can continue to generate at 20% plus from such a big base, that's a concern for other companies. Right? But I'm happy as a shareholder. Meta is eating their lunch. Business metrics is all good. Reality Labs still continue to lose. So he's not giving up on his metaverse, looks like. Those Oculus and now Ray-Ban glasses, that's the next future computing platform. While on one hand, Zuck is focused on AI, building AI models and open sourcing it and using AI to run their operations much better. They're also focused on the next gen computing platform that could be mixed reality, AR, VR, who knows what that could be. Like he's been stung once by Apple. He doesn't want to go back to the same situation wherein someone else controls his future. He wants to control the next gen of computing platform. Even with 3 billion people already on Meta platform, they still grew like 7%. How many more users can you add? Like what, we have 7 billion, 8 billion people? They already had like more than 3 billion. Now they grew it by another 3%, right? And revenue also grew 14% to 11.89. So nothing not to like in this business, even from a KPIs perspective. Right? So guidance midpoint beat the expectations, right? So once if you beat the expectations, market will kind of reward you. That's what they did. They did a share repurchase as well as dividend. Same theme across all the big AI company, all the big tech companies is CapEx investments in AI. So it will significantly grow and profitability from AI will take time. So be patient. So this is one area of concern that I have against all these big tech companies is right now everyone is investing. How much money are you going to make? Who knows? And right now they don't even talk about making money, right? So Q3 growth will slow down because of lapping as compared to last year. But yeah, nothing not to like. Market rewarded it. Stock was up nicely. So that's on Meta. Now last one. Microsoft. Except the slight margin going slightly down and is like almost negligible down on operating margin. I see everything green. It's growing 15%. With that like run rate of like $250 billion, you still grow at 15%. Anyway, what market didn't like it because stock was punished? Azure is growing, but on a slower rate. So I think they gave what Azure guidance for 28% or something. And market didn't like it. CapEx, huge increase in CapEx, which like increased 55%. And they say we're going to continue to spend more. Market didn't like that one as well. So that's a concern. That growing revenue 15%, 40% gross profit. I mean, these numbers are just great numbers. So yeah, so Azure grew 26%. So returned $8.4 billion to shareholders and valuation was stretched. Market is waiting more to hear on the Copilot, which I think we heard in the call. So not that bad. But again, the main question is on little slowness in Azure. But I mean, as you grow big, it is difficult to continue to grow at the same rate as when you were small. Like AWS is now growing at 19%. You can't continue to grow at your 50%. So that's Meta. But I don't think I have any concerns on Meta I looked at, run through the same profile. It checks all the boxes, man. It's a good business. So cool. That brings us to the end of a marathon stock review. I think this is the first time we have reviewed so many stocks. Next week again seems to be busy. A lot of companies reporting earnings. I'm gonna do Palantir. I own this. Berkshire Hathaway already reported today morning, so I need to go and read through that. Uber. What else? Axon is a company that everyone talks about. I haven't been able to buy more, and I know they are kind of monopoly, but just their operating margin is so low. Other than that, I think I only concern margin problem. I want to see Axon moving more into software. They have a almost oligopoly in the business. Airbnb I own, want to see that. Shopify I own. Disney I own. What else? Magnite. Yeah, so looks like next week gonna be busy as well. All right, guys, with that, let's finish it right here. Looks like this earnings season is gonna keep us busy for more than our scheduled time. So I appreciate you guys staying here. Any last minute? Good. Are you welcomed? Cool. All right, let's SMCA earnings thought. I have no idea. I don't own the stock. I don't like their business profile. So I've never owned SMCI. Cool. All right. I think that's it for today. So those who gave me some stocks, we'll come back and start with those, and then we'll pick up some earnings. Cool. Bye-bye. Thank you very much.
Thank you.